the 13th of December 2025, 4:00 p.m. Eastern. The options market just wrapped up for the week. And hidden inside the open interest reports data most people never even glance at is a figure that should scare every silver short 40927 call option contracts at the $70 strike. Expiry Friday, the 20th of December 2025. That's 1 week from today. Each contract represents 5,000 ounces of silver. Run the numbers 40927 contracts times 5,000 ounces equals 204635,000 ounces. Roughly 200 million ounces of silver that could be called for delivery in just 7 days. Now let me show you why that figure can't be met with what's actually available. COMEX registered silver inventory as of today is 92.4 million ounces. The options market is pointing at 200 million ounces. The exchange has about 92 million available. That leaves a gap of 108 million ounces. That's not a simple squeeze, that's a hard math problem with no easy solution for the entities legally obligated to deliver. And here's the punchline. The entities that sold those calls, market makers and banks, are legally on the hook if those options finish in the money. If silver settles above $70 on Friday at 4:00 p.m., the banks must locate about 200 million ounces. They don't have it. This is the gamma trap. JP Morgan, widely seen as one of the biggest sellers of silver options on COMEX, is right in the center of it. In this video, I'm going to break down how options actually work and why this setup is being treated like a ticking bomb. I'll explain why December 20 could become one of the most violent moments in silver market history. Let's start with the basics, because if you don't understand options, you won't understand why this turns dangerous fast. A call option gives you the right, not the obligation, to buy silver at a specific price by a specific date. Say silver is $62 and you buy a $70 call paying a premium instead of full exposure. If silver runs to $80, you exercise the option. You buy at $70, sell at $80, make $10 per ounce, subtract the $3 premium you paid, and you walk away with $7 net profit per ounce. Not bad. But here's what most people overlook when you buy that call. Someone has to be on the other side selling it to you. That seller is the market maker. Usually it's a bank or a large trading firm. When the market maker sells you the call option, they pocket your $3 premium. But now they've taken on a liability. If silver trades above $70, they owe you silver. So how do they control that risk? They hedge. This is where the mechanics start to matter. When the market maker sells a $70 call while silver is at $62, that option is out of the money. The odds of silver reaching $70 might be around 30%. So the market maker doesn't hedge the entire exposure right away. They hedge based on delta. Disclaimer, I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned here. This is strictly educational analysis using publicly available information. Delta measures how much an option's price moves relative to the underlying asset. At the money, options often sit around 0.5 delta. Out of the money, options might be closer to 0.3. In the money, options can climb toward 1. In plain terms, if you sell a call with a 0.3 delta, you hedge by buying about 30% of the underlying. If one contract represents 5,000 ounces, you hedge by buying roughly 1,500 ounces worth of futures to stay closer to neutral. If silver rises, you lose money on the call you sold, but you gain on the futures you bought, so the moves offset. But here's the trap. As silver climbs and gets closer to the strike, delta rises too. The option can move from 0.3 delta to 0.5, then 0.7, then 0.9. As delta increases, the market maker must buy more futures to stay hedged. That extra buying pushes the price higher, which lifts delta again, which forces even more hedging, feeding the loop. That's the gamma squeeze. Gamma is simply the speed at which delta changes. High gamma means delta ramps up fast. And when you've got roughly 4,000 call options sitting at $70 while silver is at $62, that's a huge block of gamma exposure coiled up like a spring, hedged at roughly 35% of notional. That's roughly 70 million ounces worth of futures they're holding as a hedge. But if silver reaches $68, those options jump to about 0.7 delta. Now they need to be hedged for 140 million ounces, which means they must buy another 70 million ounces in the futures market. And if silver touches $70 on Thursday, delta pushes up to around 0.95. They'd need to hedge roughly 190 million ounces. That's an extra 120 million ounces they'd be forced to buy in 48 hours. Where do you buy 120 million ounces when COMEX has only about 92 million ounces in registered inventory? You don't. So what happens next? The price gaps. It can rip from $68 to $75 in minutes because supply simply isn't there. That move drags even more calls into the money, and then the $75 calls light up. Another 2,000 contracts. Another 100 million ounces of implied demand. The squeeze turns into a chain reaction. This is what people point to with GameStop in January 2021. This is what happened with Volkswagen in 2008. And this is what's being set up in silver. Now, let's look at who's on the other side of this trade, because this is where it starts to look outright dirty. The CFTC publishes a report called The Commitments of Traders. It breaks down who's long and who's short across the futures and options markets. The key buckets are commercial hedgers, banks, and producers, and non-commercials, meaning speculators and hedge funds. In the latest COT report, dated the 10th of December, 2025, the commercial category, dominated by JP Morgan, is net short roughly 5,000 silver futures contracts. That's about 250 million ounces net short. They're positioned for prices to fall. But it doesn't stop at futures. Options positioning shows commercials, net short calls, and net long puts. They sold call options to speculators. They sold the $70 calls. They sold the $75 calls. They took in premiums. They assumed silver would never get there. Now, those commercials are sitting on a ticking bomb, short futures and short calls at the same time. And in 7 days, if silver is above $70, they're heading into margin calls that don't let up. Let's get specific because the details matter. Open interest at the $70 strike for the December 20 expiration 40127 contracts. Open interest at the $75 strike 22450 contracts. Open interest at the $80 strike 15330 contracts. Total across those three strikes 77900 contracts, representing nearly 400 million ounces of implied silver demand. If silver closes at $80 on Friday, every one of these finishes in the money. Market makers would be on the hook for roughly 400 million ounces. COMEX registered inventory is about 92 million ounces. That leaves a gap of more than 300 million ounces. This isn't a squeeze. It's a structural break between paper claims and physical reality. This is a default event. Now, who sold these options? We don't get individual names because that's confidential. But we can reasonably infer JP Morgan is the biggest commercial trader in the silver market and has been for 15 years. According to estimates from analysts like Ted Butler, JP Morgan controls around 30% to 40% of the commercial short position. If commercials are net short 5,000 futures contracts, JP Morgan is probably short about 15,000 to 20,000 of those. And if the same pattern applies, they likely sold a similar share of the call options too. Say, JP Morgan sold 120,000 of the 4,000 calls at $70. That's 60 million ounces. If silver hits $70, JP Morgan alone would be on the hook to deliver 60 million ounces. They don't have it. Their vault reportedly holds 200 million ounces, but that's their proprietary stash, the silver they built up over 14 years. They're not going to hand it over to call holders at $70 if silver is heading to $100. So what do? They cover. They step into the futures market and start buying. But the moment they buy, the price rises, which forces more delta hedging from other market makers, which drives the price higher, which pulls more options into the money. It becomes a doom loop. And JP Morgan can't get out cleanly without either delivering the metal or watching the price go straight up. This is what it looks like when the biggest bank in America gets cornered by its own greed. Let me take you back to the two most famous short squeezes in modern history because the wiring is the same. January 2021 GameStop, a struggling video game retailer stock sitting around $20. But retail traders on Reddit spotted something: hedge funds were short 140% of the float. More shares were sold short than even existed. Add in a mountain of call options and things turned explosive. As retail bought the stock and loaded up on calls, market makers had to hedge by buying shares for delta coverage. That pushed the price from $20 to $40. More calls moved in the money. More hedging followed. The price ripped from $40 to $80, then $150, then $300, peaking around $483. Short sellers got wiped for billions. Melvin Capital collapsed. Market makers barely held on. And the only reason it stopped was brokers flipping the switch on buying. Robinhood, TDE, Times Trade, and others restricted GameStop trading. If they hadn't, the price could have gone to $1,000 or more. October 2008, Volkswagen. Porsche had been quietly accumulating VW shares. They owned 43%. The government of Lower Saxony owned 20%. That left only 37% available to trade. But hedge funds were short. 13% of the company convinced VW was overpriced. Then Porsche announced it had secured call options on another 31% of the company. Suddenly the free float dropped to just 6%. Hedge funds were short 13%, but only 6% of shares were actually available to buy. Panic set in. Funds scrambled to cover their shorts. The price exploded from $200 to over $1, 0 inches, just 2 days. Volkswagen briefly became the most valuable company on the planet. Porsche walked away with roughly $10 billion. The hedge funds were wiped out. That's what happens when you're short something and supply disappears. Now apply the same logic to silver. JP Morgan and the banks are short about 250 million ounces through futures and roughly 200 million ounces via options. Total short exposure is about 450 million ounces. COMEX inventory sits near 92 million ounces. They're short about 5 times the available supply. GameStop peaked around 1.4x. Volkswagen was roughly 2x. Silver is closer to 5x. This is the mother of all short squeezes, and it detonates in 7 days. Markets open at 9:30 a.m. Eastern. Silver is trading around $66. The $70 calls are inching closer to the money. Delta starts climbing. Market makers begin buying futures to hedge. Volume surges. By 10:00 a.m., silver hits $67. Every dollar higher forces additional hedging, roughly 5 million ounces per hour, feeding on itself. By 11:00 a.m., silver trades at $68.50. Algorithms recognize the gamma squeeze setup. High-frequency traders jump ahead of market makers buying first because they know banks must buy. Silver rips to $69.20 in 10 minutes. At 1:20 p.m., silver tags $70. The calls are at the money and Delta accelerates. Market makers panic. They need to buy another 50 million ounces, but only about 10% of futures supply is available. The price gaps violently to $74. Delta jumps to 0.9, igniting $75 calls, and another 110 million ounces of exposure. Silver hits $78, trading is halted, then resumes and spikes instantly to $81. After the close on Friday, the real damage begins. By 6:05 p.m., the clearinghouse issues margin calls. Market makers who sold the calls must now post collateral for deeply in the money options. At $86 silver, the $70 calls are $16 in the money, multiplied by 5,000 ounces per contract and roughly 4,000 contracts outstanding. That's $3.2 billion in margin just for the $70 strikes alone. Add in the $75 and $80 calls, and total margin calls climb to roughly $5 billion. Do banks have $5 billion in spare cash earmarked for silver margin? Some might. Many won't. Smaller market makers especially won't, and they're forced to sell other assets to raise liquidity. That selling spills into stocks, bonds, and other commodities. Contagion sets in. By Monday morning, December 23, option holders face a decision. They can cash settle and take profits in dollars, or they can exercise and demand physical silver. Historically, about 95% of options settle in cash, but this setup isn't normal. Refineries are constrained. COMEX registered inventory sits near 92 million ounces. Physical premiums are running $12 over spot. In this environment, smart money wants metal, not dollars. Assume just 20% of option holders demand delivery. That's 8,000 contracts, or 40 million ounces, an enormous withdrawal from the registered supply. Registered inventory has already fallen by 20 million ounces in the last 2 months. Pull another 40 million and you're down to 52 million. That's system stress territory. If 30% demand delivery, 60 million ounces registered, inventory drops to 32 million. That's a breaking point. By Wednesday, December 25, Christmas Day, banks are in emergency meetings. They try to cut deals with option holders offering cash to avoid delivery while calling the CFTC to push for intervention. By December 31, silver is near $95, inventories are collapsing and the squeeze has worked. January opens with silver near $100, another options expiration ahead, and banks trapped in a feedback loop they can't escape. What would actually have to happen to keep silver below $70 and save the banks? Scenario 1 is aggressive price suppression. Banks dump 2,000 futures contracts into the market, roughly 100 million ounces of paper selling. Silver drops from $62 to $58, but industrial buyers step in, buy 50 million ounces, and the price snaps back to $62. Scenario 2 is a COMEX rule change. Margin requirements are raised to 100%, making leverage speculation nearly impossible. This forces out leveraged longs, but does nothing to stop physical buyers and does not erase outstanding call options. Options are binding contracts, and wiping them out would trigger lawsuits and undermine trust in the exchange. Scenario 3 is force majeure. The exchange declares an emergency and suspends silver trading entirely. This nuclear option stops the squeeze, but destroys COMEX credibility. Price discovery shifts elsewhere, likely to Shanghai, and COMEX becomes irrelevant. There is no clean exit. Every path ends in pain as the clock keeps moving toward expiration in 7 days. Conservative scenario, the banks fight hard and manage to suppress price action through midweek. Silver fails to break $68 until Thursday, when gamma pressure forces hedging. Silver clears $70 Friday morning and settles near $74. Calls finish barely in the money, delivery stays limited near 10 million ounces, and the system holds. Moderate scenario, the squeeze unfolds largely as described. Silver reaches $70 on Wednesday and gamma accelerates. By Friday, silver closes near $83. The $70, $75, and $80 calls expire in the money. Margin calls reach roughly $5 billion, 40 million ounces leave COMEX, inventory falls near 52 million, and stress intensifies. Aggressive scenario, the full cascade hits. Silver breaks $70 on Tuesday, and gamma goes vertical. Hedge funds and algorithms pile in. By Thursday, silver trades near $85, and by Friday's close, it hits $102. All calls to $100 finish in the money. Margin calls exceed $10 billion, and registered inventory collapses toward 12 million ounces. Emergency action follows. The CFTC meets over the weekend. Trading is halted Monday. When it reopens, silver gaps to $120. This is the nightmare scenario, and it's more realistic than most people think. One more element matters, the volatility feedback loop. As silver approaches $70, implied volatility in the options market rises sharply and begins to amplify every move. Higher volatility makes options pricier. Premiums on fresh call options surge. But here's the hidden trap. When implied volatility rises, the delta on existing options can rise too. An option sitting at 0.5 delta with 20% implied volatility might shift towards 0.6 delta when implied volatility jumps to 40%. That forces market makers to buy even more futures just to stay hedged. So a rising price pushes volatility higher. Higher volatility lifts delta. Higher delta demands more hedging. More hedging drives the price up again. It's a feedback loop that fuels itself, and once it starts, it becomes extremely hard to stop. We saw a version of this in March 2020 when VIX volatility ran from 15 to 85 inches 2 weeks and the system buckled. We saw it again in January 2021 with GameStop when implied volatility spiked to 400% and the options market effectively froze. Now that same dynamic is lining up in silver. Stack a volatility shock on top of a physical shortage, a gamma squeeze, and trapped short sellers, and you get a super event that ends up in textbooks. To the 20th of December, 2025 could be that day. So what do? Long physical, silver, or miners you hold? This is asymmetry, not a trade. If you're short silver in any form, exit immediately. If you're in paper exposure like SLV, weigh force majeure risk carefully. If you're in cash, a final suppression dip may be your entry. If you trade options, be cautious. Volatility is inflated, and halts can wipe you out. Physical metal remains the cleanest exposure. One last thought. What we're watching isn't only a short squeeze, it's the potential death of the paper silver market. For roughly 40 years since the Hunt brothers, the silver price has been set in New York's futures market with paper contracts traded back and forth. That structure is now being pushed toward its breaking point under growing physical stress. The physical market used to be an afterthought. But that structure only holds when there's plenty of physical supply, industrial demand is soft, and nobody really cares about taking delivery. December 2025 is the opposite backdrop. Physical shortage, industrial urgency, and delivery demand surging. The paper market is cracking, and the options squeeze is only the spark. The real story is silver, shifting from paper priced to physically priced. In a physically priced world, the price is set by the person who controls the metal, not the person clicking buttons on a screen. We're watching an era end, the era of suppression, the era of endless paper, the era of JP Morgan dominance in silver. It's not ending because a regulator passed a new rule or a law changed. It's ending because the math stopped working. You can't sell 200 million ounces of call options when only 92 million ounces exist. You can't short 450 million ounces when industrial buyers need 300 million ounces. The numbers no longer balance. And when the numbers don't balance in a market, the market breaks. We're 7 days from that break. The 20th of December, 2025, 4:00 p.m. Eastern. The bell rings, options expire, and the gamma trap snaps shut. This isn't revenge or justice. It's math. Hold your silver. The clock is ticking.